Okay, it's 8 o'clock, so I'll go ahead and get started. We will be using Learning Catalytics today during class, so you want to make sure that you log into learning.catalytics.com, which a number of you already have, using your Pearson username and password. We'll use the same session for the first 5 chapters. I've got all the questions in a mix in the first 5 chapters. This first question is just to make sure that you understand how the questioning works. Basically what happens, and I guess you won't see me because I took away my video. I will deliver a question, give you a certain amount of time to answer it. I monitor how many people have answered the question. And then when it looks like most of you have answered the question, then I'll say, 10 more seconds or 15 more seconds or whatever the case may be. All right. So, excuse me, I'll leave that up for a bit so that as people log on, they can answer the question, and then I'll shut it down. All right, moving on. So here are some basic cost terms and their definitions. Cost is a sacrificed or foregone resource to achieve a specific objective. The actual cost is a cost that has occurred, whereas a budgeted cost is a predicted cost. And of course, in this class, we're going to deal a lot with budgeted costs. Cost object, anything for which a cost measurement is desired. For example, the cost object can be a department, it can be a whole plant, it can be a product. So you're going to assign cost to a specific cost object. And managers use cost information in 2 main ways. They use it when making decisions. Here we have some additional terminology. Cost accumulation. Cost accumulation is a collection of cost data in an organized way by means of an accounting system. Cost assignment, on the other hand, is a general term that encompasses the gathering of accumulated costs to a cost object in 2 ways. We might want to trace costs. Tracing accumulated costs have a direct relationship to the cost objects. We generally think of direct materials and direct labor as something that we can trace. Allocating accumulated costs have an indirect relationship to a cost object. Generally, that would be manufacturing overhead. All those costs that are associated with the factory that are not direct materials or direct labor. We use a systematic method for allocating the indirect costs, such as activity-based costing, process costing, or allocating with a predetermined overhead rate. Okay, we're getting ready for our first real Learning Catalytics question. Sustainability, oh, that's not the right question. Wait just a minute. Those were the ones from the previous slide, so I gotta go to the right one. I need a mouse. So, cost tracing is the assignment of direct cost to the chosen cost object, a function of cost allocation, the process of tracking both direct and indirect costs associated with the cost object, or the process of determining the actual cost of the cost object. Does anybody have any questions? I know some of you may have logged on after I gave the directions for getting into Learning Catalytics. Okay, about 15 more seconds.
How do we get into the Learning Catalytics?
Okay, it's learningcatalytics.com. Log on with your Pearson username and password. And there's only one session open, so that'll be the session you'll choose.
I have a quick question, not about Learning Catalytics.
Sure.
Are you gonna release like the PowerPoint slides once we go through them?
Yes, I will.
Okay.
I am recording this. It'll be difficult to watch because it's going to have all these pauses in it. But I will also be releasing the videos.
Okay, perfect. Thank you.
You're welcome. Participation at 25% for correct. It may be 50-50, but I think it's 75-25.
Okay.
It does keep you alert and awake, even at 8 o'clock in the morning. Hey, this one must be a little tougher because I've only got 9 responses so far. I'll give you another 20 seconds. There we go. So another way that we can differentiate between direct costs is to identify them as direct or indirect. Direct costs can be conveniently and economically traced or tracked to a cost object. You will also note as I go through these slides that I repeat myself in a lot of different ways. I use some of the same terminology. I use varying terminology for the same concept because that's just kind of the way cost accounting works. But I'm trying to build and repeat myself a lot. Indirect costs cannot be conveniently or economically traced or tracked to a cost object. Instead of being traced, these costs are allocated to a cost object in a rational and systematic manner. There are several different ways to allocate costs. We might use predetermined overhead rates, we might use an activity rate, or equivalent units. These methods will be covered later. The salary of a plant administrator at BMW, as an example, is an indirect cost of a particular automobile because unlike the steel or tires that are used, it is virtually impossible to trace plant administration costs to a particular car line. To get a better understanding of the types of items that fit into each type of cost, direct or indirect, we present some examples on this slide. So we have direct costs of material, steel or tires for a car as an example, labor, the assembly line wages, and then we have the indirect costs. Those are the, sometimes, like a lot of times, I call those manufacturing overhead costs. One way to think about this is the association between the direct costs and the specific requests for those items in the production process. We need 4 tires and some amount of steel in each car, but we don't requisition some number of hours of administration time or rent for each car or for the line. Managers are much more confident about the accuracy of the direct costs of cost objects, such as the cost of steel and tires of the X6, because these costs can be easily traced to the cost object. So these are less fuzzy, okay? Indirect costs are a different story. Some indirect costs can be assigned to cost objects with reasonable accuracy. Others are more difficult. Think about electricity and rent and property taxes. It's going to be really hard to say how much electricity was used to build each car, how much rent was used to build each car. A few factors affect the direct indirect cost classification. We can look at the materiality of the cost in question. The smaller the cost, the less likely it will be economically feasible to trace the cost. So if you think about a cake and it has salt in it, the cost of the salt is very small. The amount of salt in the cake is very small. It just doesn't make economic sense to trace it. We also have the availability of information gathering technology. Technology makes it possible to consider more and more costs as direct, because we have Excel spreadsheets, we have scanners, barcode scanners. So as we put butter into the cake, we can scan the bar of butter before we put it in, and then it can be traced very easily. So we have a lot more opportunity now to make costs direct that we didn't have, 10 or 15 years ago. The design of operations. If parts of a facility are dedicated to a particular cost object, such as a specific product or a particular customer, we are generally able to classify more costs as direct. A specific cost may be a direct cost for one cost object and an indirect cost for another. As an example, when you think about the PMW line, if you've got your a factory supervisor over one particular product, then it could be direct for that one particular product. But if the factory supervisor is over multiple different lines, then the factory supervisor is indirect for the different lines. There are 3 product costs, and I'm going to hammer on this a lot. Okay, I'm going to say, what are the 3 product costs? And I'm not going to make you do it because it's virtual, but normally in a face-to-face classroom, I make you shout out direct materials, direct labor, manufacturing overhead. So basically, there are 3 product costs: direct materials, direct labor, and manufacturing overhead. Direct materials and direct labor are those direct costs that we've been talking about. They can be easily and cost-effectively identified with a specific cost object. Manufacturing overhead is an indirect cost and is allocated to the cost object. Okay, we talked about tracing and allocating a few minutes ago. Notice that indirect labor and indirect materials are part of manufacturing overhead. Why is this? How are indirect materials and labor different from direct materials and labor? Again, consider a bakery. Direct materials are major components of a baked item, such as flour, sugar, and butter. The cost is a significant factor in the finished product. On the other hand, cinnamon has a low cost and is used in small quantities, so it is considered an indirect cost. It's actually indirect materials. An example of direct labor is the baker who makes the products. The baker is hands-on, and the amount of time used for each product can be allocated. The supervisor, on the other hand, oversees all of the bakers, is responsible for training and overall planning. They rarely touch the actual product, so assigning a specific cost to a product based on their time doesn't make sense. Instead, we allocate the cost based on a consistent method and rate. Product costs are part of inventory and do not become an expense until the items are sold. They will be on the balance sheet. Period costs are expensed on the income statement as they are incurred. They are generally classified as selling costs and administrative costs. So some examples, these are going to be all non-factory costs. As an aside, if it's a factory cost, if it says factory, it says plant, it's going to be manufacturing overhead. If it says manufacturing, all of those are going to be manufacturing costs. Manufacturing costs are always part of the product. Okay, so your period costs are no manufacturing costs. We could have executive salaries, office rent, sales commissions, rent on office building, depreciation on office equipment. All of these things have nothing to do with the factory. They are expenses, they are incurred, and they are period costs. Okay, so which of the following is a period cost?
I still can't get on the Learning Catalytics. It's asking for a session ID.
If you don't have that, if it should show up, but if it's not, it's 904 77833. It should be the only session open.
Yeah, it doesn't show me any sessions at all.
Huh.
It's open now, thank you.
Okay,
I can't find it either. Where is it?
learningcatalytics.com. Moving on. Variable costs change in total with change in activity. So an example of a variable cost would be, again, direct materials such as chocolate chips in chocolate chip cookies. I guess I'm hungry this morning. I keep talking about bakeries. Chocolate chips, the more chocolate chip cookies I make, the more chocolate chips I will use. On the other hand, the cost of the chocolate chips per chocolate chip never changes. It only changes in total. So the variable cost will change in total with the change in activity, but it will be the same per unit. Fixed costs will change per unit with a change in activity because fixed costs are unchanged in total. The baker salary, $40,000. I don't care if that baker makes 10 dozen cookies or 100 dozen cookies within something called the relevant range, which is the number of cookies that the baker can actually make, then that salary is not going to change. On the other hand, obviously, if he makes 10 dozen cookies, it's going to cost more per cookie than if he makes 100 dozen cookies. Costs are fixed or variable for a specific activity or for a given time period. That's what I was talking about with the relevant range. When considering variable and fixed costs, it's very important to know that if you're looking at the cost in total or per unit. Variable costs change in total in proportion to changes in the related level of activity or volume of output produced, and fixed costs remain unchanged in total for a given time period, despite changes in the related level of activity or volume of output produced. So here's a comparison of the costs, summary, variable costs total dollars change in proportion to the output, but the cost per unit remains unchanged. On the other hand, fixed costs are unchanged in relation to total dollars, but they change inversely with output. The more output we have, the lower the cost per unit. In these charts, we see the graphs of variable and fixed costs using the number of steering wheels for the BMW X6. Panel A shows a graph of the total variable cost of steering wheels. The cost begins at 0 because if we make no X6s, we don't have any cost for steering wheels. Fixed costs are presented in the panel B, where we have a line across at the $2 million mark right here. The annual total fixed supervision costs for the X6 are that amount and will be that amount whether we assemble 0, 20,000, 40,000, or 60,000 cars. Of course, over time, that may change. At a consistent assembly rate of 0, we may eliminate the supervisor position. At an assembly rate of greater than 60,000, we may need a second supervisory position. In this slide, I consider a few additional concepts. The mixed costs. They contain both fixed and variable elements. And I'm hoping that most of you worked with the high-low method when you were in managerial accounting, but that's really what we're talking about here, mixed costs. A cost driver is variable, such as the level of activity or volume that causally affects cost over time. The relevant range is a band or range of normal activity within which the fixed cost would not change. The idea of the relevant range is the same, is that at some point in time of increased production, fixed costs will increase. All right, there are two other costs that we want to review, prime costs and conversion costs. Prime costs are direct materials plus direct labor. They are the costs that can easily be identified with the end product. Those are again, our direct costs. Conversion costs are those costs that convert the direct materials into a finished product. That would be direct labor plus manufacturing overhead. So, as a review, guess what? There's a question coming up. The three product costs are direct materials, direct labor, and manufacturing overhead. Prime costs are direct materials and direct labor. And conversion costs are direct labor and manufacturing overhead. We've introduced two major categories of costs, direct and indirect, and variable and fixed. As a result, we have the following combinations of costs: direct and variable, direct and fixed, indirect and variable, indirect and fixed. Once again, using the BMW X6 as an example, we see here examples of the various combinations that can occur for direct, indirect, and variable fixed costs. This comes from page 37, Exhibit 2-5. More often than not, direct costs are variable. They change with level of production. However, as indicated in this example, there are times when variable costs can be part of manufacturing overhead, making them an indirect cost. In this case, the power cost associated with the plant where many products are made is a variable cost. Obviously, the more power that's used, the more the cost. But it's indirect because the power cost cannot be easily traced to a specific product. Fixed costs are frequently indirect, part of manufacturing overhead. Things like depreciation expense, supervisory salaries, and factory rent would all be part of manufacturing overhead. However, as this example shows, fixed costs can be direct. The salary of a supervisor for a specific product would be a direct cost. It can be easily traced to that product, and it would be fixed. It would not change with level of production. We've been discussing how variable costs and fixed costs differ in terms of their unit costs. For this reason, unit costs should be used cautiously. Because unit costs change with different level of output or volume, it may be more prudent to base decisions on a total dollar basis. Again, fixed costs don't change with production, and so because fixed costs are part of unit costs, we want to look at unit costs carefully. Manufacturing sector companies purchase materials and components and convert them into finished goods. These companies typically have one or more of the following three types of inventory. Direct materials, those are the resources in stock and available for use. We have work in process. I call it both work in process and progress. Goods partially worked on, but not yet completed, often abbreviated as WIP. We accumulate those three product costs that I was talking about before, direct materials, direct labor, and manufacturing overhead, in the work in process inventory and in the work in process account. Then we have finished goods. Those are the products completed and ready for sale. So again, three types of inventory: direct materials, work in process, finished goods. And note also that merchandising sector companies hold only one type of inventory, the merchandising inventory, because they don't make anything, they just sell stuff. Three terms are commonly used when describing manufacturing costs. These terms build on the direct versus indirect cost distinctions we discussed earlier. Indirect manufacturing costs are also referred to as manufacturing overhead costs or factory overhead costs. Previously, I have said that there are three product costs. This slide highlights this concept once again. Those are my three product costs, also known as manufacturing costs. So product costs and manufacturing costs are synonymous. Also touched on this before, but again, I'm trying to layer and to make sure that you get things presented to you in a multiple different ways. So inventoriable costs are all costs of a product that are considered assets in a company's balance sheet when the costs are incurred, and then are expensed as cost of goods sold only when the product is sold. For manufacturing companies, all manufacturing costs are inventoriable costs. Direct materials, direct labor, manufacturing overhead, those are all inventoriable. Period costs are all the costs in the income statement other than the cost of goods sold. They are treated as expenses of the accounting period in which they are incurred because managers expect those costs to increase revenues in only that period and not in future periods. Okay, next question. Here we see Exhibit 2-7, page 42, representing the flow of costs through the balance sheet accounts for inventoriable costs only and into the income statement account for both inventoriable and period costs. Note the three inventories: raw materials, work in process, and finished goods. Okay. Direct materials, direct labor, manufacturing overhead, all of these flow into work in process. Note also how the three product costs are accumulated in the work in process inventory: direct materials, direct labor, and manufacturing overhead. Once all of the costs have been accumulated in work in process and the products are completed, they are transferred to finished goods. All of the inventories are on the balance sheet. So your direct materials inventory, your work in process inventory, your finished goods inventory, those are all on the balance sheet. When finished goods are sold, the cost of these finished goods is transferred to cost of goods sold on the income statement, thus matching the revenue with the relevant cost of goods sold. Revenue minus cost of goods sold is gross profit or gross margin. Period costs are then subtracted from gross profit to arrive at operating income. Okay, so this, and I actually have another slide that takes you through the T accounts on this, but that's a little later. Okay, from our first panel on the multi-step income statement, we use a figure called cost of goods manufactured. Okay, so we need to calculate the cost of goods manufactured. Step one is to calculate the cost of direct materials used by adding beginning direct materials to the purchases and then subtracting out the inventory, ending inventory. Step two is to calculate the total manufacturing costs incurred. What are my three product costs? Direct materials, direct labor, manufacturing overhead. So that would be my three costs here: direct materials, direct labor, and then manufacturing costs. Those are my three product costs. So we add the beginning inventory, the beginning work in process inventory. My mouse is not working, there we go. Beginning work in process inventory to the total manufacturing costs incurred, giving us total manufacturing costs to account for. Okay, but remember that your beginning work in process already had direct materials, direct labor, and manufacturing overhead from the previous period. So we're going to add that to all the costs that are incurred this period to come up with the total manufacturing cost to account for. All right, then we subtract the ending work in process from total manufacturing costs, and that gives us our cost of goods manufactured that we used in the last slide. Okay, any questions on that? To report the flow of costs just illustrated on the income statement, we calculate the cost of goods sold as follows. Beginning finished goods inventory plus the cost of goods manufactured, that we just calculated earlier. That gives us our cost of goods available for sale. Then we subtract out our ending finished goods inventory, and that will give us our cost of goods sold. Okay? If we subtract cost of goods sold from net revenues, you get gross margin. We already talked about that. From gross margin, we subtract period costs to obtain operating income. All right, now, I just want to recap because all of that stuff looks really complicated, and it really isn't. This recap repeats that there are three inventories: raw material, work in process, and finished goods. All three inventories would be a line item on the balance sheet. The really cool thing about this slide, it introduces the concept that calculating the inventory is handled generally the same way for all three. We start with beginning inventory and then add some costs, which gives us the amount of inventory available. We then subtract the ending inventory, and that will tell us what was used, manufactured, or sold. I'll walk you through the specific calculations on the next several slides so you'll know which things to look for. So, example, raw materials. We have some amount of raw materials on hand, say 50 pounds of flour. We buy 300 pounds of flour, giving us 350 available pounds. At the end of the period, we have 100 pounds of flour left in inventory. Let me just see something. I haven't ever done, I'm trying to use words. All right, so
Okay.
we have 50 pounds of flour to start with. We add another 300 pounds of flour. That gives us 350 available pounds. At the end of the period, we have 100 pounds of flour left in inventory. So 50 plus 300 equals 350 minus 100. So we must have used 250 pounds of flour in production, okay? 350 pounds available minus 100 pounds that were still on hand at the end of the month. If we assume a pound of flour is $1, then the value of raw materials used would be $250, okay? So that's raw materials. Beginning plus purchased equals raw materials available minus ending. Oh, maybe this is the problem. I was trying to write on the wrong thing. Nope, that's not the problem. All right. Beginning plus purchased equals raw materials available minus ending inventory equals raw materials used. Okay, now we're going to move on to work in process. This time we start with the beginning inventory of work in process. Keep in mind that we accumulated all of the costs for production, direct materials, direct labor, manufacturing overhead in the work in process inventory account. So that was beginning inventory. So let's assume we have 15 wedding cakes partially completed at the beginning of the month with a total cost of $150. During the month, we add direct materials cost of $250, direct labor cost of $575, and manufacturing overhead cost of $175. That would give us total costs added of $1,000. And again, notice here, it's made up of direct materials, direct labor, and manufacturing overhead. So we take that 150 that we had at beginning work in process, and we add the $1,000. That would give us $1,150 in the work in process account. At the end of the month, there were 12 cakes in inventory at a total cake cost of $350. That means the cost of goods manufactured would be $800. The $1,150 total manufacturing cost to account for, minus the $350 in ending work in process, and that gives us the cost of goods manufactured of $800. That amount would be transferred to finished goods. But again, notice, beginning plus the cost added equals account for, minus the ending gives us our cost of goods manufactured. Same basic functionality as direct materials. Finished goods. Beginning plus cost of goods manufactured, cost of goods available, minus ending equals cost of goods sold. Okay? Beginning inventory consists of 3 wedding cakes with a value of $240. We transferred in $800 worth of cost of goods manufactured, 10 cakes, for a total cost of goods available for sale of $1,040. 240 plus 800 gives us $1,040. At the end of the month, we have 2 cakes on hand with a cost of $160. Thus, the cost of goods sold is $880. The $1,040 from cost of goods available minus the $160 for ending inventory, giving us $880. The number of cakes also reconciles because we started with 3, we added 10, we subtracted 2, 11 cakes at $80 each for a total cost of goods sold of $880. Okay. We're going to have some calculation questions. Okay. And I have added a new line into the facts. I have the calculation you just made, direct materials used, has now been added as a line item. So you don't need to recalculate that. I'm going to give you a hint. Beginning plus manufacturing costs added equals available minus ending equals cost of goods manufactured. What are my 3 manufacturing costs? What are my 3 product costs?
Fucking knows.
Well, this one's a little tougher. All right, we got a couple of people who got it right now. I didn't tell you which inventory we're dealing with. I just said beginning. You have to remember that cost of goods manufactured deals with a specific inventory. And notice that I have added in addition to the direct materials, I've now added the cost of goods manufactured. So you do not need to recalculate cost of goods manufactured. And when we're dealing with cost of goods sold, which inventory are we dealing with? You can mute your mic. You're calculating out loud. Okay, 30 more seconds. The next slide I've got here is just kind of a T account representation. So I have raw materials. If I make purchases, I debit it. If I use it, I credit, I reduce the raw materials inventory and move it over to work in process. My direct labor just comes from some sort of salary account, sales account, salary account, okay? We have something called a manufacturing overhead account. Okay, we haven't really talked about that much yet, but again, this should be reviewed, so hopefully you've heard of hopefully you've heard of manufacturing overhead as an accumulating account. So we calculate the actual cost here. Say we incur $2,000 depreciation, debit manufacturing overhead for depreciation expense. Different from what you would do in a non-manufacturing company, because in a non-manufacturing company, that depreciation expense would not be accumulated in manufacturing overhead. It would just be on the income statement as depreciation expense. We have power or utilities expense for the plant. Again, because it's a manufacturing item, it's for the plant. We would accumulate it in the manufacturing overhead account, not directly on the income statement. So we accumulate all of these manufacturing overhead amounts in our actual column. Debit the manufacturing overhead, not the regular expense account on the income statement. And then we use some sort of a rate, a predetermined overhead rate, an activity-based rate, something like that, and we apply the overhead so that we can get the overhead into the work in process inventory. Okay? The previous example we just did, I just told you what the manufacturing overhead costs were. Okay? But normally we would accumulate the actual and then we would apply, which would reduce the overhead account and increase the work in process account. 3 costs: direct materials, direct labor, applied overhead. Once we have our 3 costs, our work in process is finished. We have some amount of stuff that's done, so that reduces the work in process account, credits it, and increases the finished goods inventory account work in process. Okay. Anthony's Concrete Works manufactures concrete drainage pipes and applies manufacturing costs to production at a budgeted indirect cost rate of $15 per direct labor hour. The following data are obtained from the accounting records for October 2018. Direct materials, direct labor, indirect labor, plant facility rent, depreciation on plant, machinery and equipment, sales commissions, and administrative expenses. Now I'm going to push out the question sheet. I'm not going to show it on the screen because you want to have these costs on the screen. So I'm going to leave the costs on the screen and then you can answer the learning catalytics question. Okay, check all that apply. Which of the costs are product costs? So let's talk about this. Which ones are the product costs? Well, direct materials and direct labor. Everybody pretty much got those. But what are my 3 product costs? Direct materials, direct labor, and manufacturing overhead. What are the components of manufacturing overhead? Anything that's a manufacturing cost, but not direct materials or direct labor. So indirect labor, manufacturing overhead, that's a product cost. Plant facility rent. We know it's a manufacturing cost because it says plant. Depreciation on plant machinery and equipment. So that's also a product overhead, manufacturing overhead cost. It is, in fact, manufacturing overhead. The last 2, sales commissions and administrative expenses, are selling and administrative.
So basically everything on the screen was included?
Nope, sales commissions and administrative costs are not product costs.
Okay, that's what I thought. So it was just direct labor, indirect labor, and plant facility rent?
Those will be part of manufacturing overhead. So those are product costs, direct materials, and direct labor.
Yep, and direct materials, right.
Exactly. So the first 5, the first 5 are product costs. The next question is, what are the period costs? That should be pretty easy, given that you now know what the product costs are, and they can't be either product, they can't be both product and period.
Oh, I was mistaken. I didn't know that the depreciation on plant machinery and equipment was included in the product cost.
Yes, because it says plant machinery. If it said office machinery or office equipment, that would not be part of product cost. But because it's plant, it is part of manufacturing overhead, so it is part of the product cost.
Got it. Thank you.
You're welcome.
I actually prefer to learn accounting on Zoom because then we can have personal questions like this
Oh, okay.
as we go along.
Not a problem. Yeah, everybody's afraid to ask questions in a face-to-face class. Okay, let's go another 15 seconds. I think everybody's got the hang of this one. It's 100% correct at this point. Okay, so the sales commissions and the administrative expenses are your period costs. Again, you can't have both. A cost will not be both period and product. Okay, here's a toughie. What are the prime costs? You need to remember what the definition of prime cost is. Okay, let's go. All right, so prime costs are the direct costs, direct materials and direct labor. So 375,000 plus 216. So the answer is A and B on that one.
Oh, I didn't know there was a question up there. That is my bad.
Okay. All right, this next one. What are the costs, which of the following are manufacturing overhead costs? Now, we discussed that several times, so you should be able to do that one pretty good. Okay, so our manufacturing overhead costs, those are all of our product costs that are not direct materials or direct labor. So C, D, and E, indirect labor, plant facility rent, and the depreciation on the plant machinery. Okay, which of the costs are conversion costs? So our conversion costs are the product costs that are not direct materials. They are the direct labor and the manufacturing overhead that converts the direct materials into a finished product. Some of you did put sales commissions and administrative expenses, and those would be period costs, those would not be product costs.
So can you clarify one more time what was the answer?
Conversion costs would be direct labor, indirect labor, plant facility rent, and depreciation on plant manufacturing and equipment.
Okay.
All the
Okay.
manufacturing overhead costs that are not direct material.
Okay. And then sales commissions and administrative expenses are what?
Period costs.
Okay.
Okay. Now we're going to look at the dollar amounts. Lost my question.
One more thing. Was direct materials involved?
No, conversion
Okay.
costs. Conversion costs are the things that convert the direct materials into a finished product.
Into a finished product. Okay.
Correct. Yeah. Okay, what actual amount of manufacturing overhead costs were incurred? 5,000 for depreciation on plant machinery, that would give us 280,000. Okay, I think that is it. Okay, good timing. All right, so we will end here. And the first homework assignment is due on Sunday at midnight. It's chapters 1 and 2. And this will have to render into a video, and then I will post the video. So it should be available. It'll probably take an hour or so, but it should be available at that point. So I
Okay.
will see you all next Tuesday. Any final questions?
You mentioned prime cost.
Yes.
Can you clarify what
Yes.
those
Prime
are?
costs are the direct materials and direct labor.
Okay.
Okay. And actually, at this point, that might help.
Costs.
Okay. Any other final questions? All right. I'll see you all. Oh, go ahead. Go ahead.
Nope, I don't have a question. I'm just writing all of this down.
Oh, okay. So this worked pretty well, I think.
I
So we
think
will,
this does, yeah.
yeah. So we will do this again next Tuesday at 8 o'clock.
Okay. All right, thank you.
You're welcome.
Thanks.
Have a good day.
You too.
Yeah.
Thank you. Bye-bye.
Bye-bye.
Bye bye.